A government motorcade sped through early morning Nairobi traffic, carrying sealed packets stamped immediate currency order. The directive inside was brief. China's yuan unit would assume settlement of the nation's pending infrastructure liabilities without delay. Before ministries could react, Brazil's agriculture authorities issued their own notice. Soybean shippers were instructed to ready yuan-based clearance procedures for cargo heading to Chinese terminals. The ripple widened within hours. In Johannesburg, contractors at a major construction hub discovered that fresh funding had been deposited overnight, not in dollars but entirely in yuan. As capitals attempted to trace the common link, BRICS leadership released the statement that escalated uncertainty into global strain. A new settlement framework, asserting coverage across 185 jurisdictions, had gone live. Governments were unsure of its true reach, only that the axis of financial leverage had abruptly tilted. Banks in Singapore and Johannesburg were first to report unusual settlement patterns after yuan. Linked transfers processed more quickly than standard cross-border timelines, a shift traders tied to enhancements within China's cross-border interbank payment network. Financial Times reporting last month noted that quarterly SIPS volumes had approached 13 trillion yuan, marking a sustained rise in yuan, denominated billing for commodities and industrial inputs. The acceleration mirrored an IMF warning in its October review, observing that emerging markets were moving into non-dollar channels at the fastest rate since 2014. The pace produced visible consequences in Africa's development lending sphere. Reuters said in late September that Kenya, Angola, and Ethiopia had converted portions of their external debts into yuan arrangements to blunt exposure to U.S. rate swings. Kenya's treasury said dollar liabilities had become harder to manage as global borrowing costs climbed, while China's policy lenders offered steadier repayment schedules using local currency equivalents. Angola had earlier disclosed that its state oil firm had shifted contract settlements to a yuan-linked model to stabilize fiscal outflows. Southeast Asian trade ministries cited comparable reasoning when Indonesia launched its first offshore yuan bonds earlier this year. Bloomberg data showed the three-tranche issue drew orders more than triple the supply, attracting regional asset managers seeking closer access to Asian credit. Jakarta officials said the move eased reliance on dollar markets, which had become increasingly reactive to Federal Reserve tightening cycles. The sale followed a series of bilateral arrangements enabling Indonesian state entities to settle coal and palm oil exports directly in yuan. Weeks later, the Bank of Korea and the People's Bank of China renewed a nearly $50 billion currency swap, which the Wall Street Journal reported would help Seoul manage exchange rate pressure during geopolitical strains. The renewal aligned with the expansion of Korean semiconductor output, destined for Chinese production chains, making currency steadiness vital for manufacturers. Korean trade authorities said the swap arrangement provided operational room for companies dealing heavily in East Asian currencies. Additional momentum came when South Africa's National Treasury confirmed that upcoming development initiatives would be financed through yuan-denominated BRICS channels. Reuters reported in mid-October that the mechanism would fund logistics corridors, power projects, and water systems. South African officials said the approach reduced vulnerability to exchange fluctuations that had complicated earlier dollar-based funding. The announcement coincided with the central bank boosting its yuan reserves to broaden currency diversification. Across the Middle East, energy flows shifted as Bloomberg noted that Chinese refiners had increased yuan-settled crude purchases from Gulf suppliers. Dubai traders said settlement records showed steady growth in yuan usage for petrochemical inputs. The movement strengthened after China and the United Arab Emirates established a yuan clearing framework earlier this year to streamline trade in metals, energy, and transport machinery. UAE officials told the Financial Times that yuan clearing cut transactional friction for exporters closely integrated with Chinese markets. Latin American administrations documented similar movements. Argentina, constrained by a shortage of dollars for trade settlements, drew on its yuan swap line to cover import obligations, Bloomberg reported in April. Data from Buenos Aires Central Bank indicated the arrangement was used to pay for machinery, electronics, and industrial components sourced from China. Brazil, for its part, completed a direct yuan settlement pathway last year, allowing firms to conduct transactions without routing through intermediary currencies. Brazilian lenders told Reuters the system cut processing times and reduced hedging expenses for domestic businesses. Momentum built further as China's currency appeared more frequently across global trade finance indicators. Swift figures cited by the Financial Times showed the yuan's share of trade finance climbing to roughly 7% in September, a sharp rise from levels 3 years earlier. Analysts observed that the gain displaced portions of the euro and yen, both of which saw lower shares. The dollar held its lead, yet the data signaled an evolving pattern shaped by broader settlement options. The strategic picture shifted again after the Bank for International Settlements published updated statistics revealing that cross-border yuan lending to developing economies had increased by more than $300 billion equivalent over the previous 4 years. BRICS officials said the rise reflected ongoing demand for credit tied to infrastructure, telecom, and transport initiatives. Borrowers in Central Asia, according to country-level notes, remained among the most active users of yuan-based financing. A closer review of China's overseas balance sheet showed foreign-held yuan deposits and bonds had exceeded $400 billion equivalent, based on Bloomberg's aggregation of People's Bank of China figures. Traders in Hong Kong said offshore yuan liquidity had deepened as institutional investors sought alternative yields amid volatility in global bond markets. The appetite encouraged several European corporations to float yuan-denominated debt to tap Asian capital channels. As these developments unfolded, IMF reserve data showed central banks were gradually raising their allocations to non-dollar currencies. The fund noted that the combined share of reserves held in alternatives had reached levels last seen in the early 2000s. Its review stressed that diversification did not imply abandonment of the dollar, but rather a strategic recalibration by reserve managers responding to shifting trade routes and geopolitical pressures. Complexity increased when European lenders began adjusting internal risk models to account for higher volumes of yuan-settled transactions. Financial Times sources at large banks in Frankfurt and Amsterdam said risk committees were updating hedging frameworks to reflect expanded exposure to East Asian currencies. The revisions paralleled a rise in euro-yuan swap activity reported by Bloomberg's derivatives desk. The dollar's global standing remained strong, but the spread of swap lines, direct settlement systems, and alternative clearing networks added competitive layers. U.S. officials said during recent briefings that dollar demand continued to anchor the financial system, yet analysts acknowledged a slow but steady shift toward more distributed settlement regimes. A strategist at a major U.S. bank told Reuters the trend was gradual but durable, driven by regional blocs optimizing for cost, efficiency, and political considerations. Amid the broader adjustment, India enlarged its own non-dollar settlement avenues, offering rupee invoicing to selected partners. Reuters reported that Indian exporters increasingly relied on rupee trade to ease dollar shortages in certain markets. Though India maintained intricate relations with China, its move reflected a wider pattern of emerging economies pursuing diversified settlement routes rather than depending solely on dollar-centric systems. Russia, meanwhile, deepened its reliance on yuan settlement systems, as Western sanctions restricted its ability to use dollar and euro channels. Bloomberg reported that more than a quarter of Russia's trade transactions were being settled in yuan, a sharp departure from levels 2 years ago. Russian banks tied to the CPS network added backup routes to keep trade operations functioning under tightened financial controls. The convergence of these shifts formed the setting for the BRICS statement that unsettled markets earlier this week. Although the cited figure of 185 participating countries reflected political framing more than verified implementation, it drew attention to a broader trend. Numerous regions were already adopting components of yuan-based payment infrastructure, at a pace surpassing earlier estimates. Experts told the Financial Times that narrative momentum often accelerates uptake when governments see strategic reasons to diversify. In Washington, the Treasury Department acknowledged the need to track how alternative settlement pathways might influence demand for U.S. securities. The Wall Street Journal noted that foreign ownership of U.S. Treasuries had fluctuated modestly this year as certain emerging markets increased reliance on local currency borrowing. The U.S. still anchors the global bond market, but shifts in trade settlement patterns can affect long-term reserve decisions. Even within commodity sectors dominated by the dollar, modest changes were taking shape. In metals markets, several Chinese exchanges expanded yuan-based settlement for aluminum and copper to meet rising interest from regional buyers. Reuters data showed Asian importers were more frequently selecting yuan pricing when dealing with Chinese manufacturers, particularly for intermediate goods tied to cross-border supply chains. The ripple widened as South American grain exporters began testing yuan invoicing for shipments bound for Chinese ports. Bloomberg reported that soybean producers in Brazil and Argentina were weighing yuan-denominated contract structures to limit currency risk during peak export cycles. Traders said the move was partly driven by advantages tied to China's processing windows. Across the global south, finance ministries stressed that diversified settlement options helped reduce exposure to political shocks. African officials told the Financial Times that broader access to yuan loans and payment mechanisms offered protection against sudden swings in global financing conditions. They argued that diversified systems strengthened national flexibility during economic disruptions. As investors assess the implications of BRICS ambitions, one theme emerged from the recent IMF, WTO, and SWIFT releases. The infrastructure supporting multipolar settlement was expanding faster than prior projections suggested. Each dataset added another layer to the shift, and each layer raised new questions about long-term reliance. When trading desks closed for the week, market participants said the BRICS announcement, even if partly symbolic, revealed an underlying reality. The move toward a plural currency settlement landscape had advanced further than many officials expected. And as liquidity screens went dark, one unresolved question lingered across global markets. If the next major trade shock hits during this transition, which settlement system will absorb the impact first?